Welcome back to the Daily Crypto Deep Dive. Bitcoin is back near the same price it hit years ago. XRP is still below levels people remember from the last cycle. Ethereum and Solana are still nowhere near the sort of prices people expected when the last bull market was in full flow. So today, we need to ask the uncomfortable question. If Bitcoin was around this level back in 2021, and it is still around this level now, why should anyone still believe crypto is a good investment? And more importantly, how do you explain that to normal people? Not crypto Twitter. Not the people shouting to the moon every time Bitcoin moves 2%. I mean normal people in the office. People who are earning steady interest on savings. People putting money into stocks. People who look at Bitcoin and say, hasn't this thing already been here before? That is the question we are answering today. Before we get into it, quick mention for Kraken. If you're looking to buy Bitcoin, XRP, Ethereum, Solana, or you're just building your crypto position over time, check out Kraken through the link in the description. Kraken is one of the most established crypto platforms out there, and if you use our link, it helps support the show, helps keep Crypto News Today going, and helps us keep doing giveaways for the community. As always, this is not financial advice. Do your own research, never invest more than you can afford to lose, but if you are going to use Kraken anyway, use the link in the description and support the show, and we will send you 20 XRP when you sign up. Right, let's get into it, because the skeptics do have a point. If somebody bought Bitcoin at the very top in 2021, they may look at today's price and think, what was the point? Bitcoin hit around $69,000 in November 2021. Today, it is still hovering around the mid-$64,000 area. So on a simple price chart, it can look like Bitcoin has gone nowhere for years. And with XRP, the argument is even easier for skeptics. XRP traded higher in the last cycle than it is trading now. Today, XRP is around $1.14. So someone can quite fairly say, why are people still excited about this if the price was higher years ago? That is where we need to be honest. Crypto has not been a straight line. It has punished bad timing. It has punished hype. It has punished people who chased tops, used leverage, bought every random coin, or believed every influencer promising life-changing gains by next Friday. But that does not mean the investment case is dead. It means the investment case has to be explained properly. The mistake people make is they look only at the price and ignore what has changed underneath. In 2021, Bitcoin at $64,000 was mostly a retail-driven, hype-driven cycle-top asset. Yes, there were institutions involved. Yes, companies like Strategy had already started buying. But the wider structure was still immature. There were no US spot Bitcoin ETFs. Stablecoins were massive, but not yet being treated seriously by regulators. Tokenized funds were still a niche idea. Banks were mostly talking from the sidelines. Payment companies were experimenting, but they were not yet openly moving into blockchain rails in the same way. Crypto in 2021 was much more about speculation. Crypto in 2026 is becoming infrastructure. That is the key difference. The price may look similar, but the market underneath is not the same market. This is the line I would use when explaining it to someone in the office. I'm not saying crypto replaces savings. I'm not saying it replaces stocks. I'm saying savings protect money, stocks grow money steadily, and crypto is the high upside slice because parts of the financial system are moving onto digital rails. That is the grown-up argument. Because the person making 4% or 5% on savings is not stupid. They are protecting capital. The person putting money into an index fund every month is not stupid either. They are building wealth the traditional way. That is sensible. That is steady. That is proven. But crypto is not trying to be a savings account. A savings account pays you because the bank uses your money inside the existing financial system. Stocks give you ownership exposure to companies inside the existing financial system. Crypto gives you exposure to the possibility that parts of the financial system itself change. That is the difference. Bitcoin is not interesting because it moved from $63,000 to $64,000 today. Bitcoin is interesting because it is a fixed supply asset with global liquidity, 24-hour trading, institutional access, exchange-traded products, corporate treasury adoption, and a growing role as a macro asset. That does not mean it is risk-free. It is absolutely not risk-free. But it does mean you cannot judge it the same way you judge a savings account. A savings account is designed to preserve capital and produce predictable interest. Bitcoin is designed to be scarce, permissionless, global, and outside the direct control of any single central bank or government. That is why the upside and downside are both bigger. Now, analytically, this is where it gets interesting. When Bitcoin was around $64,000 in 2021, it was near the peak of a blow-off cycle. Inflation was still being underestimated. Interest rates were still near emergency levels. Risk appetite was extreme. Meme stocks were flying, NFTs were exploding. Random coins were going up 100% for no reason. The whole market was drunk on liquidity. Today, Bitcoin around $64,000 is very different. It is trading in a market with higher interest rates, more institutional products, more regulatory scrutiny, more professional capital, more corporate balance sheet involvement, and more serious competition for investor money. So the question is not, why is Bitcoin the same price? The question is, why is Bitcoin still standing at this price after everything it has been through? That is a much better way to frame it. Bitcoin has survived the 2021 crash, exchange collapses, regulatory pressure, banking stress, higher interest rates, ETF outflows, geopolitical tension, and multiple moments where people said it was finished. And yet it is still here, still trading around major cycle highs, and now connected to the traditional finance system through spot Bitcoin ETFs. That matters. The ETF approval changed Bitcoin's market structure. Before, a normal investor had to buy Bitcoin directly, use an exchange, manage custody, or trust a crypto platform. Now, institutions and traditional investors can access Bitcoin through regulated products. That does not guarantee price goes up every month. In fact, as we are seeing now, ETF flows can turn negative and create pressure. But structurally, it means Bitcoin is no longer just a crypto-native asset. It is now plugged into the same financial system that skeptics used to say would never touch it. That is a major shift. Now let's bring XRP into this. XRP is a different argument from Bitcoin. XRP is not digital gold. It is not a fixed supply monetary asset in the same cultural category as Bitcoin. The XRP argument is about payments, settlement, liquidity, institutional use, Ripple's ecosystem, and whether regulated digital assets can play a bigger role in moving money around the world. But again, you need to be honest. XRP still has to prove itself on price. There's no point pretending otherwise. If XRP is around $1.14 and people remember higher prices from previous cycles, then the skepticism is understandable. But the argument for XRP is not simply, it was higher before, so it must go higher again. That is lazy. The stronger argument is this. If the world is moving toward tokenized money, stablecoins, instant settlement, crypto ETFs, and regulated digital asset infrastructure, then assets linked to payment and liquidity narratives could become more important over time. But price confirmation still matters. For XRP, levels like $1.12 and $1.15 matter in the short term because they show whether buyers are defending the range or whether the market is still weak. Long term, the bigger question is whether institutional adoption and regulatory clarity translate into actual demand. That is how you explain it properly. You do not tell skeptics XRP is guaranteed. You tell them XRP is a high-risk, high-upside bet on digital settlement becoming more important. Now compare that to stocks. Stocks are easier for normal people to understand because companies produce earnings. Apple sells phones, Microsoft sells software, Nvidia sells chips, McDonald's sells food. You can look at revenue, profit, cash flow, dividends, and valuation. Crypto is harder because most of its value is network-based. Bitcoin's value comes from scarcity, security, belief, liquidity, adoption, and monetary demand. Ethereum's value comes from the idea that decentralized applications, tokenized assets, stablecoins, and smart contracts will need settlement layers. Solana's value comes from the idea that fast, cheap blockchain rails can support payments, consumer apps, stablecoins, and trading. XRP's value comes from the possibility that digital liquidity and settlement become more important in the regulated financial world. So the correct comparison is not crypto versus stocks, as if one must replace the other. The correct comparison is portfolio role. Cash is for safety. Savings interest is for stability. Stocks are for long-term wealth building. Crypto is for asymmetric upside. That means you do not need crypto to be 100% of your portfolio. In fact, for most normal people, it should not be. But having no exposure at all means you are making a bet too. You are betting that none of this infrastructure becomes important enough to matter. And that is a risky assumption. Because look at what is happening. The Bank of England is changing stablecoin rules. MoneyGram is moving deeper into Solana. Traditional fund managers are launching tokenized products on Ethereum and Solana. Strategy is still buying Bitcoin. BlackRock has a Bitcoin product. Regulators are writing frameworks. Banks are studying tokenized deposits. Payment companies are experimenting with stablecoins. This does not look like an industry disappearing. It looks like an industry being absorbed. That is the deeper point. The old financial system is not just fighting crypto anymore. It is learning how to use it, regulate it, package it, and profit from it. So when someone says, Bitcoin was this price in 2021, the answer is, yes, but in 2021, it was mostly a speculative asset at the top of a hype cycle. Today, it is a speculative asset with ETF rails, institutional access, corporate holders, clearer regulation, and a much bigger infrastructure story underneath. That does not mean guaranteed returns. It means the risk-reward profile has changed. And if someone says, I would rather earn safe interest in the bank, the answer is, that makes sense for emergency money. But safe interest will not usually give you life-changing upside. It protects you. It does not transform your financial position. That is the brutal truth. Savings are not bad. Stocks are not bad. But they play different roles. If you are trying to protect $10,000, savings might be perfect. If you are trying to build wealth over 20 years, stocks might be the backbone. If you want exposure to a possible rebuild of money, payments, settlement, and digital ownership, that is where crypto comes in. But it has to be sized correctly. The most sensible strategy is not to go all in. The most sensible strategy is to build emergency cash, invest steadily into boring assets, and then allocate a smaller amount into major crypto assets that you can hold through volatility. That is how you survive the market long enough to benefit from it. Because the biggest mistake in crypto is not being early. The biggest mistake is being overexposed, panicking, selling the bottom, and never getting to the part of the cycle where adoption starts to matter. So today's message is simple. If you only look at the price, Bitcoin can look like it has gone nowhere since 2021. But if you look at the infrastructure, the ETFs, the regulation, the stablecoin growth, the corporate treasuries, the tokenization story, and the fact that traditional finance is moving on-chain, this is not the same market anymore. The price is similar. The foundation is stronger. And that is why crypto can still be a good investment. Not because it is safe, not because it is guaranteed, but because the upside is tied to something much bigger than one chart. It is tied to the possibility that the financial system itself is changing. And if that happens, the people with sensible exposure before the rest of the office finally understands, it may be the ones who benefit most. As always, this is not financial advice. Protect your downside, do your own research, never invest money you cannot afford to lose, and we will see you at the top.